worse than 2008. Zerodha CEO's warning has investors worried. Should you be concerned? Imagine waking up tomorrow, checking your phone, and seeing your investment portfolio slashed in half. Stock prices have crashed. Panic is everywhere. People are asking, should I exit now? Or stay and risk even more losses? This isn't just a nightmare. It could soon become reality. At least that's what Zerodha co-founder and CEO Nitin Kamath is warning. According to him, if the current market downturn continues, we could be staring at a crisis worse than the 2008 financial meltdown. And if retail investors start pulling out of the markets out of fear, the impact won't just be personal, it could deal a major blow to the economy itself. Kamath's warning isn't one to take lightly. If ignored, millions of investors could be left regretting their decisions. Today, we'll dive deep into this issue, what's driving this fear, how realistic the threat is, and what you, as an investor, should be doing now. But before we begin, if you are new to our channel, don't forget to subscribe so you never miss an update. Let's begin today's important discussion without any further delay. Nitin Kamath's statement has come at a time when the Indian stock market is witnessing daily declines. Investors are confused, making decisions in a climate of fear, and market volatility is frightening everyone. Especially the retail investors who, in recent years, were drawn toward the stock market, who began investing with confidence through SIPs and mutual funds, are now the most anxious. And this fear isn't baseless. History shows that during the 2008 recession, it was the common investor who was the first to flee the market. Kamath's warning isn't meant to spread panic, but rather to prepare us to face a reality that might be approaching once again. Kamath shared some shocking data on social media platform X, which helps us understand what happened in the market after 2008. According to him, between 2008 and 2014, investment in equity-oriented mutual fund schemes almost came to a halt. People were withdrawing their money, and new investors were hesitant to enter. It was a time when fear had become the biggest force in the market. He said that the current situation is starting to look very similar. Over the past 5 years, Indian retail investors have rapidly increased their investments and adopted the idea of buying the dip. But if the decline continues, they might once again disconnect from the market. Between 2020 and 2024, retail investors played a crucial role in the rally witnessed in the Indian stock market. These are the everyday investors who once preferred bank FDs or gold for investment, but with the help of mobile apps and digital awareness, they learned about and embraced the stock market. These investors became the backbone of the market, as they saw market dips as opportunities and continued investing regularly. However, when the market starts showing persistent declines, foreign investors begin withdrawing funds, and global uncertainties increase, these are the very investors who tend to panic first. That's why Kamath's warning must be taken seriously, because this is the segment that provides stability to the market. It is also important to understand the cause of the 2008 global recession to better interpret the current scenario. The crisis began with the collapse of America's biggest investment bank, Lehman Brothers, and soon engulfed the entire world. The crisis was triggered by subprime mortgage loans, where banks issued risky loans, and when they started to default, the entire financial system collapsed. Its impact on India was devastating. The Sensex, which was at 21,206 in January 2008, dropped to just 8,160 by October 2008, a fall of more than 60%. This decline wasn't just about numbers. It was a tragedy that affected the lives of millions of investors. However, in 2009, efforts were made to revive the market through government stimulus packages, RBI's monetary policies, and global liquidity injections. But by then, it was already too late. Investor confidence had shattered, and many stayed away from the markets for a long time. This is exactly what Nitin Kamath wants to avoid repeating. He warns that if corrective steps aren't taken now, an entire generation might again distance itself from investing. This would not only hurt the markets but also deal a serious blow to India's economic growth. Today's situation is different, but it is undoubtedly dangerous. US President Donald Trump has made a decision that has sent shockwaves through global markets. He has imposed massive reciprocal tariffs on over 60 countries. The US-China trade conflict, in particular, has escalated to near-war levels. First, the US increased tariffs on Chinese goods from 54% to 104%, then China retaliated with a 34% tax on American products. In response, Trump added another 50%, and China countered with a staggering 84% tariff. What began as trade policy has now turned into a full-blown display of global power, with the world economy caught in the crossfire. The impact of this trade war is no longer limited to just two countries. The entire world is feeling its heat. Inflation risks are rising, supply chains are being disrupted, and investors everywhere are grappling with uncertainty. India is not immune to this turmoil. Foreign investors are pulling out funds, demand for the dollar is increasing, and pressure is mounting on the rupee. All these factors are contributing to the volatility in the Indian stock market. And whenever the market becomes unstable, it is the small investors who suffer first. When investors see their portfolios decline day after day, it affects them mentally. If the downturn continues for a prolonged period, many may withdraw from investing altogether. This is exactly what Nitin Kamath is trying to warn us about. He urges retail investors to act wisely instead of fearfully, to maintain a long-term perspective, and to view every market correction as an opportunity, not a crisis. But this will only be possible if there is transparency in the market, if the government instills a sense of security among investors, and if financial literacy empowers individuals to make informed decisions. The Government of India and the Reserve Bank must take these global conditions seriously and craft a cautious and strategic response. It's no longer enough to rely on interest rate changes or policy announcements. What's essential now is to preserve public trust in investment. If the common man loses faith, he may never look toward the markets again. For investors, it is crucial not to panic but to learn, stay informed, and make wise decisions. History has shown us that every downturn is followed by a new rally. But only those benefit from it who stay invested during the fall. Fear is human nature, but fighting through it is our responsibility. That's why Nitin Kamath's warning must be taken seriously, because it highlights a reality we cannot afford to ignore. The uncertainty in today's market could pave the way for tomorrow's opportunities, provided we move ahead wisely. This is not a time to panic, but to stay alert and make the right choices. This is the real test of investing, and this is the turning point where winners and losers are separated.
Has taught you something new. Do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.